Guys, am I audible?
Yes, sir.
All right. So we'll be continuing with the second session. We start with our second session now. Like I said, we stopped at discussing about the importance of an NDA and a co-founders agreement for a newly incorporated business, or if you want to incorporate a new business, right? But what happens exactly when a startup begins its operations? So there are certain business terms that you must be familiar with. One of those key terms is what is known as bootstrapping, right? So bootstrapping is basically when you start your business with your own funds. You don't acquire help from anyone, you don't take resources funding from anybody. Whatever savings that you have, whatever minimum funding that you can give to your business so that something of some sort gets started, that is known as a bootstrapping. And then once, of course, you get investors, then your investors will be mainly what you call financial investors, right? So financial investors are basically those investors which are short-term investors, right? So for instance, investors like venture capitalists, investors like private equity funds, angel investors, these are what you call financial investors, because their only objective to invest in your company is to reap dividends, make sure that they are there for around 3 to 4 years so that they can get rich returns on their investments. And once they leave, then your company can go for an initial public offering, or what you call an IPO. Any questions?
No, please continue.
All right. Okay. So your financial investors are one of the very important stakeholders, and their rights are equally crucial if you want your business to achieve any sort of scalability, because in the future it is only with their funds that you will make sure that your business acquires some sort of business standing and a reputation in the market as well. So like I said, these are some of the important terms. Financial investors, bootstrapping again is one uh, startup where the founder begins their operations by using their own resources and their own savings. No external help is taken. Then once, of course, the business gets started, you have more stakeholders, more investors. Then you start reaching out to third parties, enter into third party contracts, and similarly, the number of stakeholders keeps on increasing, right? But having said that, the most important area probably for today's discussion that we will be discussing now is the transaction part of the startup documentation. I've already explained to you the importance of an NDA and the importance of a co-founders agreement. But now let's take a look at some of the other documents. What happens when you make a business pitch to an investor from whom you want funding, right? So you will prepare a short presentation, explain about the problem that you are trying to solve with the help of your startup, explain about the commercial angle of your startup, explain how your venture is different and can achieve scalability with the investors' help, right? So if you are able to do that, then the next step in the transaction part is executing a document which is known as a term sheet. So I'll share my screen with all of you again so you can take a look at this document. This is visible now.
So the folder is visible.
Okay, now?
Yeah, the folder is visible. No, the folder is only visible.
Okay, okay. Just give me a minute. Let me try one second.
Sure.
Now is it visible?
Yeah.
Yes.
Yes.
So this document is what is known as a term sheet. It is basically a non-binding agreement that is executed between the investor and the startup co-founder or any of the founders who are there. Now, what the objective of this document is, it is to make sure that in the future, before you insert clauses in the final shareholders agreement or the share subscription agreement, right, this document lays the foundation for all the clauses that will be there in the final investment documentation that goes into it, right? So as you can see, I think this first para that explains pretty much what the nature of this term sheet is. It clearly says the term sheet is non-binding and for discussion purposes only among the company promoters and investors. So that means in the future, if you have a dispute, you will not rely, in fact, you cannot rely on the term sheet unless, of course, by mutual negotiation, there are certain binding clauses in the term sheet that could be inserted. For example, if there are confidentiality clauses which are inserted into the term sheet, and if that clause is made binding, then you can rely on it. But those kinds of clauses are very rare because ordinarily a term sheet is a non-binding piece of document. We'll just go to the important terms which we should be aware of. Okay, the first important term is this one. I hope you can see this pre-money valuation.
Yes.
All right. So pre-money valuation is basically used to define the valuation of a company before it receives any sort of an investment, right? So you are incorporating your startup as a company. You'll have certain set of authorized capital, but you'll not have any market. You'll not have any commercial resources, right? So of course your valuation will be very less as opposed to when after you receive the investment money. So pre-money valuation is basically the term that is used to explain what sort of valuation do you have before the investment, and once the investor will invest in your shares, the opposite of that is post-money valuation. So what will be the valuation of your company after the investor invests? So these terms are important because they help the investor to identify how much of the stake in the company are they holding after the investment is made. But remember, this is not a legal definition, this is strictly a commercial definition. So this is a business definition. This is of course not defined in the term sheet, nor is it defined in the shareholders agreement. But these are key terms that all of us should be aware of if you are executing a transaction. Any questions?
No, sir.
All right. Then the next term that you can see is this term, closing date. Is it visible?
Yes, sir.
Right. So closing date is basically the date on which the investor gives growth capital to your company. See, when you approach an investor, the normal strategy to approach an investor follows a series of steps. So the first step is you make a business pitch before the investor. The investor needs to be satisfied about the credentials of your business, the commercial angle, the future rights and obligations that you will be giving to that investor. Then only if the investor is satisfied, this term sheet comes into place. If your pitch is not good enough, then these clauses negotiation will all become meaningless, right? So your pitch needs to be good for the investor to be convinced about entering into a term sheet where they define this closing date, that is the date on which the investor will put money into your company. So that is the precise and exact meaning of the term closing date. And then there are many such other terms as well. If I just scroll down, there are, let's just go to the affirmative rights part first. Okay, can you see this clause? Affirmative consent of the investor.
Yes.
Sir.
Right. Now, remember, your investor, being a financial investor, will ordinarily be an institution like a venture capital fund, a private equity fund, if you are a technology based startup, normally what happens is the company, the startup will first go after their friends, their relatives, ask them to invest money in it. Later on, if you want a higher source of funding, the venture capital players, the venture capital institutions are those people who basically invest in high technology startups at the early stages of the company. So you need to convince a VC investor that what are the credentials of your business. Let's say the technology based startup is there, so you have to convince the VC investor how is your business different, who will be your future clientele, what is your business plan, right? How will your business plan fetch revenue enough so that even the investor can make money and not just the company will be surviving. These points need to be very clearly covered, but of course those things are outside the scope of this webinar because we are just talking about the part that goes into the making of the final documentation. So let's assume that you have convinced the investor about the potential of your business. So the next thing that the investor will want is an affirmative consent of certain rights. So in simple words, what it means is these are those rights that you give to the investor which are non-negotiable, right? So if you want an investment from an investor, you will have to insert these clauses in the term sheet. So there are no two ways about it. So for instance, if you are amending the company's organizational documents, that is the memorandum of association, the articles of association, after an investor has invested into your company, let's say a VC investor has invested, then without taking the consent of the VC investor, you cannot alter the company's memorandum or the articles of association. So this is what you call an affirmative right, because the investor in this scenario has a voting right. So if you will be amending the articles, then you need to take the consent of the investor. Or if you're diluting the share capital of the company, issuing shares in favor of some new investor, then also you'll have to take the consent of that particular investor. So this is what is known as an affirmative right. So these are non-negotiable rights, and you have to give them to the investor in order so that the money can flow into your company. So as you can see, this is a long list of provisions which are there: fresh issue of shares, company's liquidation, changing the company's name. So pretty much every ordinary aspect of the business, you give a chance to the investor to control, right? So that is why, because see, you are giving away a lot in return for a lot of money, right? So it has to be a two-way transaction. It cannot be a one-way transaction. So for instance, if you are approving the company's liquidation or dissolution without notifying, consulting the investor, then the investor will have a say in it. They can exercise a veto right in that regard. And using their affirmative rights, they can always stall that entire transaction, right? And no court will also
That
interfere.
means,
Yes.
so I have a doubt. That means the investor has a total right on the company's stake.
No, the investor does not have a total right. These are only affirmative rights. So, like, the investor will not ask for the management to be changed or will interfere in the everyday matters of the company, like how and with whom you enter into contracts, what kind of suppliers you should deal with. Those things the investors will not be concerned about, because the investor will only stay for, let's say, 4 to 5 years. Most of the venture capitalists stay for
Okay.
around that period of time. But in case you conduct your business which falls under any of these obligations, any of these provisions, then mandatory consent of the investor needs to be taken.
Okay.
So for instance, if you have
Okay.
started, yeah, so if you have begun your startup, you want to enter into a with another startup where your brother is a director, automatically you come into the ambit of a related party transaction, right?
Mhm.
And related party
Yeah.
transactions are very strictly viewed under the Companies Act as well. More for public companies, but even for private companies, there are certain restrictions. So in that case, because it's a RPT transaction, you need to take the affirmative consent of the investor. So there we
Okay.
cannot say
Okay.
the startup is entering into a contract on its own merit and the investor does not have any say, because it's a related party transaction, right?
Okay.
So
Okay. I got it.
yes, it's basically you are giving a lot of things under the control of the investor, but you are not ceding away control, because normally what happens is these financial investors will not be interested in having more than 50% stake in the company. In fact, they will normally be minority stakeholders, minority shareholders in the company, maximum 30-40% shares, right? But they do exercise a significant amount of control so far as affirmative rights are concerned.
Okay.
So the term sheet is basically to document the future clauses, the final clauses that will be inserted into the shareholders agreement. And again, so there are certain important investor rights as well that need to be considered. As you can see, this heading, it says investor rights. There we have clauses on IPO. So what happens when an IPO occurs for a startup? So basically, what will happen is, if let's say you have gained sufficient amount of funding, so you have gained VC funding now in different series. So a venture capital investor will not invest straight away in a bulk amount. So they will invest in what you call investment tranches. So they will invest what is known as a Series A funding. Then you have something known as a Series B funding. So these are basically investments in tranches, which is made by the VC investor. And then when your business acquires a certain degree of scalability, that is when the private equity players come in. So these are the players who invest in the late stages of a startup, not in the early stages, right? So
Okay.
the, these people need to be given a lot of rights for them to be convinced that you are serious about their rights as well and about your company. So again, these are some of the non-negotiable rights which are inserted into a term sheet as well as a shareholders agreement. For instance, take a look at this clause, the exit rights, where it reads that the company, promoters, and investor will work together to ensure an exit for the investor in a timely manner and assist the investor in selling a part or whole of their shares. Now, how much they can sell, what they will sell, will be documented in the final investment document, because this is not a binding document, so the clauses are also pretty much vague. But they do lay down a foundation on the basis of which you'll draft your final agreement. Is it clear?
Okay. Yep.
All right. Then again, similarly, we have another clause which is known as tag along clause, right? So a tag along clause is basically where, let's say, in the case of majority minority shareholders, you want to protect the minority shareholders' rights, and the majority shareholders want to sell off their shares, right? Then some sort of alternate arrangement has to be made in favor of the minority shareholders, and the founder will have to promise that I, being the founder or promoter of the company, right, my shares will also be subject to selling off if tomorrow I decide to sell off my shares. So the investor will also have tag along rights to sell its investor shares to such third party. So tag along is basically in the same transaction, the investor is saying that if you sell as the founder, then I have no interest to stay in the company, so I will also sell. So that is why it is known as a tag along right. So the investor's right is tagged along with the rights of the founder or the promoter. Is this
Okay. Clear. Clear, sir.
all right? All right. So we'll not discuss much. We'll not go into all the clauses. Of course, these are very detailed clauses, but we have discussed important provisions which are inserted. Then these terms are pretty important for us. Take a look at this part: conditions precedent to closing. Is this visible?
Yes, sir.
Now, normally what happens is after the term sheet has been executed, the due diligence process begins, right? So you will look at all the documents, records, email records, pretty much all sorts of communication, compliances, regulatory filings. Everything is checked and scrutinized in a very detailed manner so that X post the transaction, no adverse consequences will follow. Because think from an investor point of view. So if you are investing in a startup today, tomorrow, even after doing due diligence, you find that the startup is not compliant with, let's say, labor laws or environmental laws, and you have still gone ahead with the investment, right? So that is a major legal problem for the startup, meaning it's a problem for you, because if the startup lands in a legal trouble, then it is you as an investor who stands to lose out on your money. That we Let's take the example of WeWork. Adam Newman was the CEO of WeWork. It had disturbed finances, and SoftBank lost approximately $10 billion in their investment. Right? So, from an investor point of view, you need to identify warning signs in your due diligence, points of concern, which can raise a lot of litigation hurdles, legal problems in the future. You don't want those that sort of stuff to happen to any company, because if the company goes down or the company faces any sort of legal problems, litigation issues, your valuation in the startup goes down. So that means even if you are technically an investor, a shareholder in the company, because of the reduced valuation, your internal rate of return will be very less. Right? So keeping all that in mind, these clauses are very important. Condition precedent. So you will identify if any all authorizations, approvals, consent has been taken. Opinion of the counsel, that means if the legal counsel is already there. In this case, if you as a law student, if you're working as freelance for any startup, you have a very good opportunity to add value here, because startups can't really afford good corporate lawyers, but you can use your knowledge in corporate law to help those startups and help them create a solid business model. And of course, absence of material adverse change in the company. So any outside circumstance which interferes in your company. Right? And of course, non-competition, non-solicitation, this is like section 27 of the Indian Contract Act. Restraint of trade, partial restraint is permissible, absolute restraint is not permitted. Right? So these sort of clauses go into drafting the term sheet that you are seeing. And of course, these basic clauses are there. Arbitration, governing law, key person insurance is the insurance that is taken, which is also known as the director's insurance or officer's insurance, but that is not an important area for us under this topic, so we'll not go there. Any questions, anyone?
No, sir. Clear till this.
Yes. Any questions?
No, sir.
All right. So now I'll share another document with you. That is the next stage, what happens after the term sheet is executed. And this is basically that stage where once the term sheet has been executed and the due diligence has been done, then you identify certain flaws with the company on which you are doing the due diligence. So to identify the flaws with that company, you basically take the help of a due diligence checklist, which is prepared from the investor's side, given to the company, and it basically has things on which the investor wants clarity. So I'll show you the particular area where those sorts of questions are answered. I'll share the screen with you. So there is no fixed format for this, but most investors, investor lawyers, and sometimes entrepreneurs themselves, they get directly involved in this process. All right, so let me just share the screen with you. Is this visible?
Yes, sir.
Yes.
All right, so as you can see, this is a due diligence checklist. Okay, so these are indicated documents which are an absolute requirement if, as an investor, you are performing any kind of due diligence on any startup. You will need to take stock of these documents, basic corporate documents. So you have articles, including all amendments. So that means amended articles, updated articles of association. right? Any regulations, bylaws, minutes of all meetings of directors, shareholders, right? Their copies, list of states where property owned, countries where you are doing business, copies of all agreements having preemptive registration rights, third party contracts, all these things are there. And the list goes on. For example, list of all subsidiaries, equity, debt financing, stock purchase plans. We'll not discuss this much because most of these terms you are familiar with. You are familiar with debt financing, equity financing. Um, then, if you take a look at the third party contracts, material contracts, right? So, basically, you are giving the investor an opportunity to peek into your business and point out what is it that you're doing wrong. For example, sometimes we as founders may be unaware that some of our labor law licenses have expired. We may have neglected them. Now, in the due diligence process, if this comes up, then the investor will go for imposing what is known as a condition precedent. So, condition precedent is basically the investor will say that, look, you comply with these requirements. So, they'll make a list of the documents 1, 2, 3, 4, 5. This is the condition precedents that you need to comply with. Unless you comply with these requirements, we are not going to invest. So that is the objective of this due diligence checklist. It helps to identify what are the conditions that are required to be fulfilled by the company, by the startup, so that the investment transaction is a smooth transaction. Is this clear?
So one question. One
Yeah.
question, sir.
Yeah.
Sir, these are the disclosures that are to be made before a prospective investor before he makes the investments, right?
Yes, before the investment is made.
Yes. So, sir, some of these documents, most of them are basically confidential information. So, does the company also enter into an NDA with the prospective investor in case he does not invest in the company?
No, no. See,
But
the thing is that if the investor shows an interest in your company, when we discussed about the term sheet and the other clauses which were there, it is at that stage that you ask an investor first you enter into an NDA with us because that protects your confidential information. So even if
right,
the investor does not go on to invest in your company but still violates the confidentiality clause in your NDA, you can still make sure that you sue the investor because the binding agreement has been violated. So no startup will seek an investment before they enter into an NDA with the investor.
right. Okay, sir.
Right. So this is basically a check mechanism to ensure that because see sometimes investments do not work out even after years of relation with the company. We saw what happened with WeWork. So they had a very stable relationship going on, but then it fell. Right. So what do you do then if you don't have a confidentiality agreement protecting you? Then even if your investment has ended, the investor can still use that information for commercial gain. So you don't want that as a founder of a startup.
Right, sir.
Right. So most of these documents, you rightly mentioned that they are confidential, but the NDA will already be executed by then. Even if you have not executed an NDA, you will first make sure that you sign an NDA and then you share these documents. And the investor normally does not have any problem in signing the NDA because it is part of the usual, let's say, the business practice that the investor sees around. Because VCPE investors invest in multiple stages in different companies at the same time, right? So, for
Right,
instance, SoftBank has funded Ola as well. SoftBank has funded Oyo as well, right? So they go on investing like this. So it is normal practice for them to make sure that these sort of clauses are maintained, and it's completely normal for the investor to enter into an NDA.
right, sir.
All right. So this is the DD checklist. Now, once that is taken care of, the only thing which is left for us to execute is the final investment documentation. That means your clauses will be there in the shareholders agreement, your share subscription agreement, and share purchase agreement. Now, what is a share subscription agreement? It is basically the document which governs the rights and obligations of the investor and the company, but for the first time in a binding manner. So, what has been expressed in the term sheet goes into the share subscription agreement because the shareholder, that is the investor, is subscribing to your company's shares for the first time. Is this clear?
Right. Yes.
All right. So, let me just show you a sample of a share subscription agreement. And as you can see, just give me a second. Can you see the folder?
Yes.
Yes, sir.
Right. So just give me a minute. Let me check with the, yeah. So I think the document is visible now.
Yes.
No.
Sir. No. No.
Not yet.
No, sir.
Is it visible?
No.
No, sir.
All right. All right. Just give me a minute. Let me check one second. Okay. How about now?
Yes, sir.
Yeah, it's visible.
All right. All right. So remember, this is a share subscription agreement which governs the rights, responsibilities of the investor and, of course, the startup in which the investor is investing. And whatever is inserted into the term sheet, the clauses will be modified, customized, and more elaborated, and then it is inserted into this share subscription agreement. So, for instance, if you see this clause, condition precedent, if you remember the term sheet that we viewed, that also had a clause on condition precedent, right? So, that clause has again been elaborated here. I'll take you to page number 12 of the document so you'll see, for instance, how the particular clause has been defined there. Is the clause visible?
Yes, sir.
Yes.
Okay. Now, let me take you to clause 5.2 right here. See, so this is the original vague clause that was there in the term sheet that we viewed. And this is the explanation and elaboration what qualifies as a condition precedent. So basically, this clause tells us only on the satisfaction of these conditions will the investor put money into your company. So that means if any one of the condition precedent has still not been completed, ordinarily the investor will give you more time subject to negotiation. But if after repeated discussions nothing materializes, the investor is free to pull out their money, even if they have executed a term sheet. So nothing is final till the actual investment documentation is signed and the money flows into your company's account. Right? So even if after the term sheet has been executed and condition precedents have not been fulfilled, the investor is free to pull out their money. But assuming that the condition precedents are fulfilled, these are the basic conditions which are there. See, for instance, this is written that the company shall pass adequate board resolutions and shareholder resolutions by way of special resolution to principally approve the issue and allotment of the Series A subscription securities to the investor. So Series A means the first round of funding that a venture capitalist provides as an investor. So these are basically the procedural things which are there, what you should have with you before you ask the investor for money. So resolutions, filings, all those sorts of things were a requirement. Is this clear?
Yes.
So once all this is taken care of, the money flows into the account, and then the shareholders agreement is amended, because every time you receive a round of investment, your articles of association will be amended all the time. So if you receive Series A funding first, then it will be have to be amended. Series B, that's a separate tranche. The next round of funding, again you have to amend your articles of association. So this way, till the time you have received your final investment, your articles of association will be amended time and again. So once everything is done, you have to incorporate the clauses that are there in the share subscription agreement, insert it into your articles of association, and file it with the registrar of companies. So this is the last step that you take before you make sure that the investment transaction is complete. So merely executing a shareholders agreement or a share subscription agreement will not be enough. You'll have to also file the amended articles with the registrar of companies. After giving a certificate to the investor that all the condition precedents have been taken care of, all requirements, all flaws that were identified before, they have been taken care of, and now the investor is free to invest. Right? So these are basically the different stages of an investment transaction, especially when we are concerned about a startup.
I have a doubt. Suppose
Yeah.
someone
Yes.
is not seeking an investor, but
Right.
there are a few group of people are starting a startup,
Yeah.
and they have the amount of capital amount to be invested on the company. So
Right.
what kind of documents they need to make? Suppose all the three are the co-founders. They have made a co-founder agreement between them. They
Right.
haven't taken any investor from outside,
Right. Right.
and one of the co-founder is the investor.
Okay.
So what will be the terms and conditions for those startups?
Right. See, normally, if you have a co-founders agreement, and if one of the investor is one of the co-founders is also a major investor in your company, tech, technically, what people do is, because of the amount of trust that they have amongst each other, they neglect executing documents like term sheet. But just because your co-founder is also your investor, the exact same rules will need to be followed. So you will all again have to go for a term sheet if you think that this person will bring in a truckload of money into your company as the co-founder. But normally what happens is,
Okay.
yeah, normally what happens is term sheets are executed with venture capital investors and with private equity players and sometimes angel investors. If it is an
Mhm.
ordinary individual investor, like let's say three people are there, one person is just investing out of their own funds, at that point of time
Mhm.
they are just using their own money to fund the business, and it's a very preliminary stage of business. So at that point of time, even if you do not have a term sheet, it is fine, but you should at least have clauses on sharing of revenue and how the investment will be split in the co-founders agreement.
Okay. Okay. So basically, the co-founder agreement itself will include all the clauses when it is a mutually decided funding company, startup company.
Yes, yes, you can do that, because there is no limitation up to how many clauses you can insert into your co-founders agreement. So you can modify and customize it, but the clauses should have clarity in that regard.
Okay. Okay.
All right. So I'm ending the session now. We are running out of time, but thank you everyone for your valuable time. It was really an enjoyable session. I hope to host more such webinars in the future. Thank you, all of you.
Thank you, Amrit.
Thank you,
Thank
Thank
you
you,
sir.
very
sir.
much.
Thank you.
Thank you. Thank you.